Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho, and today I'm just going to analyze the markets and talk about what's going on. Alright, since I don't have enough time to talk about the whole macroeconomic factors behind all of these different type of trades that are going on and the risk factors, I'm going to already assume that you've watched some of my previous videos and just say that you guys kind of know what I'm talking about as far as the US dollar index, the Japanese yen, the risk yield trade-off that everybody's going for. But let's just start with the US dollar index. I think the US dollar index is still on an upwards trend, which is very negative for the markets. Remember, markets trade inverse to the dollar. Right now, asset managers are considering the dollar to be a safe haven, especially from stocks and foreign bonds. So therefore, people are allocating themselves out of the European bond market, and they're kind of carrying their risk over. They're kind of cutting their risks, they're cutting their losses, and they continue to buy US Treasuries, which in turn causes the dollar index to continue to trend higher. Right now we have a cup and handle pattern. The cup and handle pattern has broken above the 79.50 area, and I believe there is some strong support as the 79.50 cup neckline area. So this is the neckline. I do believe this area will be strong support. It's touched it once. I don't think it'll touch it again. Even if it does, the likelihood of it breaking down is very slim. The main reason why it's slim is because, again, the US dollar Japanese yen, what we're seeing right now is that the US dollar Japanese yen has consistently gone up a little bit. Again, I still think that the US dollar Japanese yen, I'd much rather own Japanese yens and owning the Japanese bond market because of the currency appreciation, the bond appreciation, and the bond yield appreciation, and because 95% of the bonds that are owned in Japan are owned by the Japanese citizens. So 95% of the bonds are owned by the Japanese citizens. It means that Japan is kind of impervious to huge shifts of capital, flows of capital going in and out of the Japanese bond market internationally. So again, if only 5% of the bond market or the Japanese bond market is owned by foreign creditors, that means that these foreign creditors won't have too much of an impact on the Japanese treasury bond market. Same thing with the European Japanese yen. And again, if I was a European banker or an investment bank manager, I would continue to allocate myself out of the euro into the Japanese yen, earn risk, earn a nice yield on currency appreciation, earn yield on the treasury bond appreciation, and earn additional yield from the treasury bond, which would put me ahead of the FTSE 100 and the Dow component. Okay, so again, if I was a European asset manager, this is where I put my money, because I am, from my perspective, if I wanted to be risk off, this is probably the best way I could possibly do it. So I believe the European Japanese yen trade, the forex pair, will continue its downwards trend for many years to come. Up until the Japanese bond market runs into some issues, it can't find any credit, fine. That's when we have a problem. But for right now, I believe the Euro-Japanese yen will continue to be on a downwards trend. Dow Jones Industrial Average. Right now, on the Dow Jones Industrial Average, we are in a continuous downtrend. All right, and I want to talk about something real quick. I want to talk about the fact that we have a rising star pattern right here. And every time you have a rising or Haremi star, Doji star, or whatever you want to call it, what typically happens is that it's preceded by a bearish engulfing pattern, bearish engulfing pattern, bearish engulfing pattern, and another bearish engulfing pattern every single time we've had these topping patterns, even right here and right here as well. So these are very indicative of future losses in the markets. We have rising star patterns all over the place. And the main reason why rising star patterns are bad is because when you have it at the top end of a market, it's indicative of a potential reversal. And you got to really watch out for these patterns, is that oftentimes you see these hammers, these doji stars, rising stars. Whenever you see it at the bottom, or not really after bottom, but after a major market decline or after a major market rise, you have to consider the risk. And right now, I wouldn't be buying Dow component stocks or stocks in general right now, unless if they were non-cyclicals. And even the non-cyclicals are looking a little iffy for the Dow component. However, Walmart stores is really good. I think people should continue to allocate their assets into these non-cyclical, lower risk businesses. And a lot of retail investors or retail stockholders have continued to liquidate their positions out of companies like Macy's, JCPenney, Gap, all sorts of different retailers. Amazon.com, e-commerce China, dang dang. You know, all these different companies are continuing to be liquidated, and their stock prices are starting to show that. And in return, Walmart stock continues to go on an upwards trend. Now, again, if we had a major economic contraction in the year of 2011, and a lot of credit and confidence were to continue to slump, which it already is, but let's just say confidence continues to slump even further, economic growth continues to diminish, well, retailers like Walmart, these more defensive plays, will continue to play out in both the longer-term investor will play out in favor to those longer-term investors. Now, let's consider some plays that might not play out too well, and I do own shares in International Business Machine. It is one of my 5 major long-term plays. The only problem right now is that it has broken below this area right here. It has basically broken straight through its short-term support area, through gap window right here. And just extend that trend line. Yes, we got it. It broke through gap window. It's way below that, and the only area that has real major support is that 200-day moving average. I'm thinking of cutting my losses short and perhaps going into telecoms just because I don't want to lose any more money. I had an entry at 182. I'd much rather close my trade flat out and lose 0 than continue to hold on to perhaps a losing proposition. And I think this downtrend will continue to hold for the International Business Machine. Even though IBM is a great company, the service job sector, you know, I like what International Business Machine does. I really do. Its business-to-business model is very functional. They have a great business here, but the share price is not showing for it. Therefore, I have to cut my losses or cut any potential future losses and allocate my capital into more defensive plays. Moving on. This is another stock that I really like. I own McDonald's. Yes, I am part of the reason why, you know, I'm not really part of the reason why, but let's be honest here. I have a vested interest for people to remain fat and buy burgers and continue to gain weight. Shut up. I don't care, alright? But I did go into McDonald's again just recently at around $88. And the main reason why I wanted to was because of all this austerity and all this and that, and it's going on in Europe, it's going on in the United States. And right now McDonald's is definitely the industry leader in the restaurant sector. And considering the fact that a lot of asset managers are continuing to reallocate capital from awful, god-awful stocks, or not really awful stocks, just high-flying stocks. Stocks that are trading at high PE multiples are growing really fast, and if economic growth were to contract, we have to question those fundamental factors. But that aside, McDonald's Corporation is on a continuous upwards tear. It's only trading at a 20 price-to-earnings ratio, but it has had consistent 5 years earnings per share growth rate of around 17.75%. We've seen revenue growth on a consistent basis, and we've also seen margin improvements as well. So again, for us, you know, on Wall Street, it has all the signs of a promising company, and it has a 2.83% dividend yield. So talk about that. It's a really good company. So again, I own McDonald's shares. I am a big fan of McDonald's. Please, please keep eating those burgers. I'm loving it. Okay? Moving on, Visa. Visa is another company I own. And my entry into Visa was at around $86.79. I wasn't expecting all this appreciation. But again, it is your best play considering what we're looking at between Bank of America, JP Morgan Chase, US Bank, and Visa Corporation. What is the best option? Visa Corporation. It's still, you know, financial services. However, for every transaction you make on a Visa card, Visa gets some cut of it. So 45 cents of every transaction you make on a Visa card, you know, every transaction you make, Visa earns 45 cents on it. But right now, I think regulation has altered that down to 25 cents. But that's still pretty good, you know, let's think about it. You know, how much do we consume every single year? Quite a bit. A lot of people use Visa credit cards, a lot of people use Visa debit cards. And let's be honest, Visa gets a cut every single time. So it's a no-brainer. I think people can all agree with me that people are continuing to use Visa cards on a consistent basis, and the amount of Visa card usage has continued to go up. So let's talk about the fundamentals real quick, and let's keep it short. Visa has a 23.8 price to earnings ratio. It has a 0.87% dividend yield, so you're getting dividends. That's good. It is an $82 billion company. Its earnings has consistently grown for the past 5 years. The average 5-year earnings per share growth rate has been 44.62%. So rather than owning BlackRock Corporation, and rather than owning all these other piece of junk corporations that aren't making us any money, let's own something that actually does. Visa Corporation. Visa Corporation earns yield, it's earned net income, it's earned revenue. Again, it's beating across all the boards. And not only that, we're seeing people continue to use debit cards more and more and more on a continuous basis. And the amount of consumption will never decrease. It always increases. And if it were to ever decrease to a point where there are no more transactions, trust me, we would have no more economy. So again, this is an optimistic bet on the future. Visa Corporation. Okay, moving on. Philip Morrison. Philip Morrison is a cigarette company. They sell the Marlboro brand. Okay, when's the last time you've seen somebody that buys cigarettes stop buying cigarettes? It never happens. Okay, they're addicted. Fine. We'll service them. We'll continue to make money off of them. Philip Morrison has a 4% dividend yield, and its average 5 years earnings per share growth rate is at 8%. And last year, over previous year, 21%. Price to earnings is at 16.2. It's a non-cyclical company, which makes it very, very affordable and a very good investment over the long term and over the immediate short term, considering the risks and the market volatility we're dealing with. NLY Capital Management is on an upwards tear after cutting straight through its channel, and it's on an upwards trend. Broke right above the upper channel, and it's continuing to go higher. NLY Capital Management has around a 14% dividend yield. Its earnings growth haven't been that great, but again, in this type of market environment, I would take a 14% dividend yield and deal with Bank of America or any other type of investment that has been losing money for investors for quite a while. Take care, folks, and have a wonderful day.